Hey everybody, this is Brent from Wolf on Wall Street Trade with the market update for the week ending November 1st, 2019. Happy Halloween. So there's a couple things to touch on. S&P made a new record closing high. We'll look at gold. We'll look at some economic data that came in this week and the trend, and some serious red flags that you need to be aware of. So first, here's a daily chart of the S&P 500. This is this week, so up 1.5% this week. Notice it held 30.20 and it made a new closing high. On Thursday, it came down a little bit, but look where it held support. Not just 30.20, but right here at the previous July closing high. And jumping to a 5-minute chart, this is where we left off last week with a little bull flag last Friday the 25th. And in last week's video, when I was wrapping it up, I said, this is a bull flag. It has a target of about 30.45. So it hit that target, 30.45 right here on Tuesday and then again on Wednesday. The Fed FOMC was the big deal this week. So here is where the Fed cut rates by 25 basis points, got a little knee jerk and then knee jerk up, then knee jerk down the next day. This is really typical around the FOMC. You can't trust the first move that you see, the first knee jerk. Over here on Thursday, the market came down, but partly that was Chinese officials telling Bloomberg that China doubts that a long-term trade deal is possible with President Trump after this phase one deal. So that brought the market down. We actually saw a negative divergence in IWM. Let me pull that up real quick. We saw a negative divergence in IWM on Tuesday as it was making this high. I'll show you that real quick. Here it is on 3C. You can see 3C diving right here as prices were still going up. So that brought small caps just about 2%. Here's the little flag from Friday the 25th right there at 155. So then pretty much the only average that gave us a good signal on this day here at Thursday was IWM again with a positive divergence coming off this low. And here it is right here in 3C. See the positive divergence as it tests the morning low. And then on Friday, the whole trade optimism thing started again. They had Larry Kudlow on TV. Trade representative was speaking. Trump was speaking. A whole bunch of Fed heads were speaking. So we got this nice move on Friday. This is where the S&P 500 closed at a new record high on Friday. So here that is on a 5-minute chart. And notice as we go into next week, into Monday, there's a bullish ascending triangle here. It's small. It's pretty much the same size as this one, but it was a strong close at the top of the session. Now, one other thing I said in last week's video as I was wrapping it up about this bull flag and 30.45 target, I said we're going to be getting really close to the broadening top trend line. So let me show you that. Okay, and this is a 2-day chart of the S&P 500. So this is the broadening top. Here is Friday's close. So it's about 0.2% above that trend line, which is about 30.60. Now, when would I consider this no longer a broadening top? If the S&P closes about 3% above this trend line and then holds it on a pullback, about a month or so, I would consider this pattern invalidated. But it's not uncommon for price to test above or below and kind of run stops and, shake everybody up, short squeezes. So the best performing sectors this week were the cyclicals. It's kind of that trade optimism, the sectors that are really sensitive. So that would be industrials gain like 2%, technology gained 2%. And then you had really the leader was healthcare. So that was up 3%. So what's interesting, considering that the industrial sector was up 2%, a little bit above 2%, was that the transports were down 1.5%. The transports did not confirm this high in the S&P 500. As a matter of fact, Dow barely did. So what I mean by that is the S&P 500 had made 3 new highs this week, and the Dow was still trading in this 2-week range that all the other averages were about 2 weeks ago, and it kind of extended the 3rd week, was having trouble here. So it did bust through that on Friday, but just fell short of that record high. It's not far from it, but the transports and small caps do not confirm. So this is a daily chart of the S&P 500, and this is transports in white. So after we came out of 2015's downturn, about 15%, and into 2016, when the market really took off in 2017, it was the transports leading higher. Okay, so they led higher into this high in early 2018, and then they led higher again over here into the September high of 2018. They're not confirming that new high in the S&P 500. Here's a little closer look. So what you can see is S&P making higher high, right? Higher high over here. And these are making lower highs and not confirming. So it has not moved above that April range. It certainly could. It would have to move above the high here in September to confirm. And while I'm on the topic, there's 11 S&P sectors that make up the S&P 500. Cyclicals, there's about 3 defensive, and healthcare, which is kind of defensive oriented. So how many do you think made a new high with the S&P 500 this week? Exactly 1 out of 11. So I'm going to show you real quick this participation in the market falling off pretty strongly. We already know IWM or small caps have not confirmed. They're like 9 or 10% below making a new high. But let me show you how many sectors confirmed at each one of these new highs. Okay, so let me pull it up. So out of 11 in January of 2018, 8 sectors confirmed. In September of 2018, it fell off. So 5, we're getting less participation. 4 over here, 4 over here, 1 of 11 sectors over here. It was the most influential sector, which is technology, the most heavily weighted, but 1 of 11 sectors. So participation in this rally is not great. I know somebody's going to ask, so I'll just tell you, at the 2007 top, the October 2007 S&P top, there were 5 sectors that were confirming before it rolled over, and in 2000 there were 3. And one other thing, this is one of the red flags that's not confirming, is yields. So they dropped about 6 to 8 basis points on the week as the S&P was up 1.5%. So this is the first time that they've gained in 4 weeks, and they are divergent with the S&P by 6 to 8 basis points, which is a lot. I'll show you that in a minute. So the Fed, the FOMC meeting was Wednesday, 2 o'clock. Here is the reaction. There's 2 o'clock. So it's kind of knee-jerking up and down, actually down first, up, then down, and then it rallied into the close, and the next day retraced it all and then some, and then finished the week higher. So the Fed cut the Fed funds rate by 25 basis points, and the market didn't like that. Over here, it didn't like that. At 2:30, Jay Powell had a press conference, and during the press conference, he said there would be no rate hikes without significant inflation, and this is why the market rallied into the close. This is kind of just like a no-brainer. I don't know why the market rallied on this. The Fed is in a rate cutting cycle. They've cut 3 times, so July, September, and then this week. Of course they're not going to raise rates. They're in a rate cutting cycle, and even if they were, they'd go on pause for 6 months or a year before they even considered it. So that was just, I don't know. So the market liked that. The market rallied on that. Now to other assets on the Fed. So stocks are going to do their thing. They're going to knee-jerk around. And then after usually somewhere between a couple hours and a couple days, they kind of chew it all over and they think about it. So this is the S&P 500, a 5-minute chart over here, and this white line, the 5-year minus the 30-year yield curve. Here is the Fed right here. There's the knee jerk. So what happened was yields went down and yield curves flattened on that Fed. And even after, Powell said no rate hikes are coming unless there's significant inflation, the yield curve stayed really flat, even flattened some more. So the reaction was it was not dovish enough. The reaction in stocks was it was dovish enough. VIX volatility got walloped. So put this in your mental notebook. Before the FOMC, about 24 hours ahead of them, or pretty much any Fed event, release of the minutes or Powell speaking, something like that, volatility will come under severe downside pressure relative to the S&P 500. It did that this week, about 24 hours ahead of the Fed. Here's the Fed announcement. Now what's interesting was stocks initially knee-jerked down. So did VIX. So usually VIX would go up when stocks knee-jerked down. Right there, 2 o'clock when the statement came out, they slammed volatility down. This was normal because stocks went up by then, but this was not. And that creates a tailwind for stocks. So while we're on the subject, volatility, the VIX futures speculative positioning is at a record low, record short. Okay, so shorter than when volatility exploded 200% in early 2018. So this tells you something. I mean, I think the markets are a little bit overly complacent. So they're very, very short volatility. And that may be because the Fed started QE4. And QE has always had the effect of dampening volatility. I don't watch this often, but CNN's got this fear and greed index. So we went from extreme fear a month ago, or close to extreme fear, and now we're up in extreme greed at levels basically about where we were at all these prior highs and this high back here in early 2018. This is when VIX exploded up like 200% over that month. So the market may be like very complacent here, very greedy, and then you have that record short in volatility. And here's the Fed's balance sheet. So you remember in September I did a video and I talked about the overnight repo market was just exploding. They couldn't control the Fed funds rate. So they stepped in with these daily repos now that can go up to $120 billion a day. And they started a new QE, QE4, except Powell says don't call it QE. This is like, QE 1, 2, and 3. And then this was the balance sheet going flat when they paused it. This was their normalization. They didn't get very far. So since the low here, which I think was about September, they've added over $200 billion in less than 40 days to their balance sheet. By April of next year, it's on pace to basically erase all of this quantitative tightening, the rolling off the balance sheet, the thing that Powell said was going to run in the background. Nobody would notice it. They couldn't normalize rates. They couldn't normalize the balance sheet because the market has to have this liquidity. It's addicted now. So again, the goal is to erase this, bring the balance sheet back up to here, and the Fed has already reversed a lot of the rate hikes that they did. So they're basically kind of seeing, I think, that they made a mistake in late 2018. Okay, let's take a look at gold real quick. It did pretty well this week. In fact, since the Federal Reserve on Wednesday, it is the best performing asset out of stocks and bonds. So last week I was talking about this bull flag, big bull flag, and for members, you know what this other trend line is. So it came down to this trend line, held support really well. This is as the S&P is making a new record high. So gold was acting really well. This is the highest close of the month of October, and it's above 1,500. So in my view, gold's chart still looks very constructive. I still see a breakout here having about a 7% gain for gold on the leg up. So this week was also very busy for economic data. Let's take a quick look because there's something that could affect gold and there's something that could affect your portfolio performance. Let's get to the data. We'll start with GDP. That came in better than expected. Okay, so here's the advanced GDP. It came in at 1.9. This was better than expected, but what I want to point out is the trend. When I look at economic data on a year-over-year basis, what you'll find is you'll get noise. You'll get like over here where it's rising. You get a move up and then a move down. I don't get too excited about these things. What I look at is the trend on a year-over-year basis, and it typically performs like a sine wave. So if it's coming up and then it comes down, it's not going to just spike up like this. It's going to go like this. So right now, the trend is going lower. As a matter of fact, after the manufacturing ISM came out this week and construction spending and the employment report, the Atlanta Fed runs a model called GDP Now. It's kind of their live tracking of what they expect GDP. On Friday, they lowered their estimate from 1.5, and I think consensus is somewhere around 1.75, down to 1.1. So even after that good employment report, they lowered their expectation. Another one that came out this week, it didn't get as much attention as GDP, but the Chicago PMI. So PMI kind of went flat through most of that year, and then into 2019, you can see what it's doing. It printed under 50. That means it is in contraction, and that is 1 to 4 months out of the last 5. It's in a recessionary area. Now, you might remember that this is following ISM manufacturing going into contraction as well the last 3 months under 50. So the takeaway is the manufacturing sector is slowing down, but the market narrative has been, well, U.S. economy is primarily services and services are strong. Well, the last ISM non-manufacturing, which is services, came in like this, down to 52. So it is going from up into 2019 and slowing. So this means the manufacturing weakness is creeping over into services. And remember, a print below 50 is contraction. But this is what I really want to show you. So remember, ISM non-manufacturing, that's services. It is contracting. It's moving lower. As we saw, the trend is moving lower. This is the prices. So this is interesting. The last several months, look what prices have been doing, moving up, inflationary. And here's the CRB index, commodity prices. Now this has been trending down all year. I don't know if this is going to be a breakout, but it is moving up the last couple of months, as you can see over here. So this is something to keep an eye on. And the reason I even started looking into this was because of the way the Australian dollar has been trading the last month. So here it is. This is one of my favorite currencies to watch for all kinds of things, but one of them is inflation deflation. So as we came out of that 2015 economic malaise, inflation started trending higher. We get into 2018, starts trending lower. Both growth and inflation trending lower. This is it recently. So when I look at this, it looks to me very similar to that CRB index. Now we know that growth is slowing. We just saw that on a whole bunch of data from the last week or the last month. But when you get slowing growth and inflation, that opens up what they call a stagflation environment. Now for gold, that wouldn't be fantastic because gold likes falling rates and falling real rates. If we look at the 10-year yield, here's that transition from inflationary to deflationary around the third quarter of 2018. And look how it's trading right now, chopping around in this kind of big range. It's not trending anymore. So we could be moving into a stagflationary environment. If you have a portfolio, the sectors that kind of are affected would be consumer staples. They don't do well in this environment. A sector that does would be energy. I don't know that we're there yet. I'm just saying there are some things that look a little inflationary recently. Okay, so we're going to take a look at the 3C charts for the averages. One of the reasons I use this program, Warden Stock Finder, is because it offers about 2 weeks of intraday data, which is more than most programs do. But I'm running out now. This trend has gone on so long, it's getting very difficult to scale. So 3C should be lower over here with price. But just pay attention to the trend. The absolute level does not matter. So picking up from last week's video, I said, the market was moving up, but we were getting no confirmation, very flat in 3C. And then even as we came into this week, you can see going into the Fed, that knee-jerk high, no confirmation on that. A little bit towards the end of the week, but none of the averages are confirming. The prior week, QQQ had looked a little better. It was confirming up on this trend over here. Now, this is a relative negative divergence because if I could scale back more data, you would see that 3C was way higher. So it was a relative negative divergence. That stopped confirming this week. IWM had some of the best signals intraday on the week, but its overall trend also is not confirming. And that stopped right about over here. It started not confirming, a little negative divergence, which is common when you go into consolidation like this. But since we've had these gains, look what 3C is doing. It's diverging from price. Towards the end of the week, we did get a little confirmation. And on an intraday basis, this was definitely the best. Here it is on an intraday basis. So this is the week. On Tuesday, I said there's a negative divergence here as price was at the high of the day. And it came down the next 2 days. But here's where that positive divergence came in on Thursday. And then Friday, again, not confirming very well. But what it's telling me overall is there's not very much conviction. And this is what 3C normally looks like in almost any environment. So that real flat trade is not typical. The last time we saw that was in July. So basically right over here, it started going limp like that and started trending sideways and then started diverging a little bit lower, not real sharp. It was just showing a lack of conviction in the buyers over here. And that's basically what it has been like since here. That's not necessarily a red flag, but we've also seen internals looking very weak most of this week, even as the S&P made a new high here. And here, internals were like the day was unchanged, basically. If you hadn't seen price, you'd think the day was flat, unchanged, 0%. Now to get to some of those red flags. Real quick before I do, this is the S&P 500, and this is volatility's term structure. And as I mentioned before, this week down here, let me see if I can put a pointer on it. The lowest it's been since back here October 3rd, which was right there as we just saw. That's not necessarily a red flag. That just says the market is really complacent. Okay, so red flag number one, leveraged loans. This is the S&P 500, and this is leveraged loans in blue. So these looked horrible coming into the beginning of October. So we got all this trade optimism and everything. They actually moved up with the S&P, so they confirmed most of this on a short-term basis from here to here. But then on Monday, as the S&P made its first record high, they started to diverge. So how much of a big deal is this? Well, that's up to you. I mean, over here, they didn't confirm a new high in July. Over here, they went negatively divergent at September. And now we have this monster divergence, and it's moved out of this confirmation stage over here. By Tuesday or Wednesday, we started to see high yield credit really negatively diverging from the S&P 500. So stocks are saying this is a risk-on environment, and then high yield credit is going risk off. Now keep in mind, a lot of these, this one and the former one I showed you, went ex-dividend on Friday, but the point is very, very divergent, and we've seen credit diverge from the S&P 500 before and lead it both up and down. Here it is on a daily chart, and these may not look big or huge, on a daily chart. I watch these every day, intraday. You can see a divergence here, not confirming a new high, a divergence here, which is pretty decent. And then we have another divergence across this whole entire new high and then starting to plunge this week. So high yield credit is getting risk off. And then another one I've been talking about is the US dollar versus the Japanese yen. So you can see it was consolidating over here in a triangle like the major averages were at the time. Here's the Dow. So this is that period of consolidation. Dow was very flat in this kind of rectangular price range consolidation. So that is where USDJPY was consolidating in that triangle. So here's the initial breakout on Monday following the S&P to a new high. Then as we get towards the middle of the week, this is a failed breakout. Okay, so we had a breakout from the consolidation, tried to move higher with the S&P, failed breakout. This signifies risk off. Here's another way to view that. This is S&P futures in the red and green candlesticks, and this is USDJPY in blue. So here we come into this week. There's that knee jerk on the Fed FOMC. Here is the pair going risk off. This looks a lot like the credit charts I just showed you. And then we have the same scenario in yields. Yields were down 6 to 8 basis points this week, down big versus the S&P. Here is that consolidation range, just like USDJPY or the Dow. Here is the breakout above initially, and this is a failed breakout, so came back down. Here's another way to view it versus the S&P 500. So here's the 10-year yield. You can see when it diverged over here, prices came down. So we have a big divergence here in the 10-year yield as well. And we can see at the previous highs, divergence here, divergence right here, and you have a divergence here, but you also have this pretty big divergence going across. But this is the one that I'm more concerned about. So the takeaway is this. These are 4 big red flags in credit, in currencies, and in bonds that are disagreeing with the S&P 500. And here's, an example of where it's led, where credit has led the S&P higher. It's leading lower here. Most of these indicators, I don't use them for price targets, but they're trading at levels where the S&P was last under 3,000, some under 2,970. So that would be some 2 to 3% lower as of where they are as of Friday, and this all developed this week. Now, in terms of price action, I can't argue against this at all. It is beautiful in terms of a bullish consolidation. You have this little triangle here, bull flag over here. So price action in the S&P or the averages, with the exception of the Dow until Friday, looks pretty good. I have no bones to pick with that. But you have 3 different markets that are screaming a red flag in treasuries, in currencies, in credit. So keep an eye on all those. I was almost ready to act on a trade on Friday. The only reason I didn't was because we had pretty solid price action Friday in this little consolidation here. Tuesday of next week, we do have some important economic data that the market's going to be paying attention to. The services PMI, and also on Tuesday is the ISM non-manufacturing or services. So that's going to be a big day. Keep it on your calendar and pay attention to those other asset classes we talked about. That will do it for this video. If you liked it, please give it a thumbs up. Have a great weekend, everybody. Members, I will see you on Monday.